Think moving your money to safer places will protect you during a recession? Warren Buffett, one of the smartest investors ever, says that could be the #1 mistake people make. While helping millions improve their finances, I've seen even expert investors humbled by recessions. But recession doesn't have to mean regret. I'm breaking down 5 money traps that seem smart but actually destroy your wealth during a recession. I'll also give you better strategies you can use to stay strong and even grow your money while others panic. First up, panic selling. When the stock market drops, it's normal to freak out. Your brain literally thinks you're in danger, like you're being chased by a wild animal. And that's why so many people slam the sell button. Here's the truth. When people sold during the 2020 crash, they locked in huge 30% losses. Robert, a 33-year-old realtor, sold all his investments in March 2020. 6 months later, the market had completely bounced back and even hit new highs. He missed it all. This is what I call the double whammy. You sell at the bottom and make your losses permanent, and you miss the recovery and lose even more money. In fact, financial planners say panic selling can delay your retirement by 5 to 10 years. Imagine working 10 extra years because of one bad decision. Here's the good news. History shows that markets always recover, from the Great Depression to 2008 to COVID. So the smarter move? Stick to your long-term plan. It's not easy, but it works. People who stayed invested during the 2008 crash got back to where they started in just 4 years. Those who sold, it took them closer to a decade to recover. That's years of lost time, lost money, and lost dreams. The next trap, running to safe investments like gold or utilities. Sounds smart, right? When markets crash, people rush to things they think are recession-proof. But here's the trick. When everyone piles into the same safe places, it creates a bubble. And the only thing you can be sure about bubbles, they pop. For example, in 2011, gold prices shot way up because everyone was scared. But soon after, gold prices crashed. People who thought they were being safe lost a ton of money. Instead of chasing what feels safe, here's what works: diversification. Spread your investments across different areas: stocks, bonds, real estate, and more. In other words, don't put all your eggs in one basket. It's not glamorous, but boring investing wins in the long run. Trap number 3, stopping your regular investing when the market drops. Most people pause their investments during crashes, but that's the exact opposite of what you should do. Imagine your favorite store is having a 50% off sale. Would you stop shopping? No way, you load up. It's the same with investing. When prices fall, your regular $500 buys more shares. You're getting stocks at a discount. Warren Buffett loves this strategy. He famously said, "Be greedy when others are fearful." If you keep buying while everyone else is panicking, you set yourself up for massive gains when the market recovers. The trick? Automate your investments. Set it and forget it, so fear doesn't mess up your plan. Want to take it even further? Create a crash fund, extra money you can invest when the market drops by 10, 20, or 30%. Turn market crashes into your best opportunities. Now let's talk about the high yield trap. When your portfolio is hurting, those 12% guaranteed return offers look so tempting. But watch out. That's when scammers and shady investments show up. They know you're vulnerable. They promise huge returns with no risk. It sounds like a lifeline, but it's usually a trap. During the 2008 crash, even giant banks and fancy hedge funds fell for these kinds of investments and lost billions. Here's your safety check. Whenever you see a big return offer, ask yourself, what risk am I really taking? Because risk and returns go hand in hand. If you can't explain an investment to a friend in simple terms, don't invest your money there. Better to miss out than to get scammed. Last track, messing up your emergency fund. Having cash saved up is smart, but if all your money is sitting in a regular savings account during high inflation, guess what? You're losing purchasing power every year. It's like having a gas tank that gets smaller and smaller without you noticing. At the same time, don't go throwing your emergency fund into stocks either. You need that money safe and ready. Here's the best way. Have 1 month of expenses in a high-yield savings account, 2 to 3 months of expenses in money market funds, and any remaining longer-term reserves in certificates of deposit or short-term bonds. That way, your money stays safe, grows a little, and beats inflation without taking big risks. During a recession, your emotions are the real enemy, not the economy. So here's the bottom line. How you react matters more than what happens. Being prepared is better than trying to predict the future. And consistency beats panic every single time. But remember, surviving a recession is just the beginning. Watch the video on your screen to up your investing game in under 8 minutes.